So welcome to the module on the money market and capital market. And in this module, we're going to talk about things like mutual funds, treasury bills, stocks, bonds, equities, and so on. So let's get to it. So what is the money market? It's basically a way for governments and blue chip companies to raise short-term funds. So blue chip companies will be large corporates, companies that have been around for pretty long time, have a large balance sheet. So the Dangotes, the Nigerian breweries, and so on. And they use these money market instruments anytime they need to borrow short-term funds from the market. Now, I've done written two articles on the money market if you want to do a deep dive. So Plumptre.com/treasury bills and Plumptre.com/money market. Now, these are some examples of money market instruments. Some you're already familiar with. So treasury bills. These are discounted securities issued by the federal government and they're backed by the Central Bank of Nigeria. So they're essentially sovereign securities. Your principal and your returns are guaranteed by the federal government. So unless the federal government itself goes broke and cannot meet its obligations, you're typically fine. And that's really a very rare occurrence for a government to be unable to meet its obligations. It happened to Greece once upon a time, but typically what happens with governments is if there's an issue, they would reschedule as opposed to completely default, because once a government has been known to default, it becomes more difficult for that government to raise funds, whether locally or internationally. So typically governments do not default on their sovereign obligations. Now, treasury bills are said to be discounted. It's very simple. You get your interest up front. So, for example, if you're going to be investing in an instrument and the return is, say, 20%, and you want to invest 100,000 naira, what usually happens is the government will take your investment less the interest. So instead of taking 100,000 naira as the investment, the government will take 80,000 naira. So they've essentially already given you your interest of 20,000 naira up front by discounting the initial capital that you're going to invest. So at the end of the tenor, what happens is that you then get your 100,000 naira back. So at the point of investing, you invest 80,000 naira. Essentially, you've gotten your 20,000 naira interest up front, and then at the end of the investment, you get 100,000 naira back. So you've gotten your 20,000 naira interest up front, and then you get the total value of the capital you wanted to invest at the end of the tenor. So that's how treasury bills work. It may be a bit complicated, but that's the general principle. Now, for bankers' acceptance, these are secured instruments issued by blue chip companies and they're guaranteed by banks. So whereas treasury bills are issued by governments and guaranteed by the CBN, bankers' acceptance are issued by companies and guaranteed by banks. So you essentially get, quote unquote, a post-dated draft. And drafts are typically one of the most honored instruments in Nigeria. So you're given a quote-unquote post-dated draft, and then at the end of the tenor, during which you borrowed that company money, you get your money back, and it's guaranteed by the bank, not the company. Okay, now for money market funds or mutual funds, these are funds where people can come together and pay smaller amounts of money to invest in securities. So these securities are issued by asset management companies, and what they do is that they pick the instruments for you. So you don't have to think about, should I invest in treasury bills? Should I invest in bankers' acceptance? They go out and look for the investment opportunities, and then they more or less split that opportunity into smaller chunks so that people with as little as 5,000 naira can invest in a piece of the larger opportunity that the asset management company has structured. So the entry price is typically low. It's for people who really don't want to think about what to invest. They just go to the website of the asset management company, see a list of what they're offering. There'll be a description of the risk profile. It will be stated there. Is it guaranteed? Is it not guaranteed? So all the information will be on the website of the asset management company, and it will also give you the entry price. It will give you the minimum tenor. The company will tell you, is there a penalty for liquidating early, all of that. So the asset management company has literally just done the work for you. That's a money market fund. And money market funds invest in money market instruments alone. Now, for commercial papers, these are unsecured securities issued by the FMDQ Securities Exchange. Is one of the exchanges that we have in Nigeria, as well as asset management companies on behalf of blue chip organizations. So it's unsecured in the sense that, unlike bankers' acceptance, where you're issued the equivalent of a draft, with commercial papers, it's unsecured, meaning that there's a risk involved. So your assurance really is just the profile and the performance of the company. So you're betting that, oh, that company is going to do well and it's not going to go under during the tenure of your investment. So it's there's a risk element, but because of that risk element, the return on investment for commercial papers is usually higher than what you would get from any other money market instrument. Now, here are some features of the money market. Typically, it's the highest performing quote unquote guaranteed investment class. So even for the unsecured money market products, you will very rarely hear of a default. So a lot of times, that's why individuals and corporates prefer to invest in the money market. So if you're dealing with a pool of funds that you cannot afford to lose, a lot of times money market will be your only option. And if your risk profile is extremely low, money market will be your only investment option. And then for T-bills or treasury bills, the upfront interest is great for endowments and trusts. So endowments that have a lot of funds, for example, if your parents are extremely rich and just happen to die while the kids are very, very young, what usually happens is, if the will states that the children can't come into that inheritance until they're 21, for example, and you have about 10 years before they become 21. Now, you don't want to risk that investment on anything, that has a high element of risk. So what usually happens is the trustees of that will just set up a trust and perhaps invest in T-bills. So the upfront interest can be used to pay for the children's school fees, the children's bills, while the capital itself is completely safe. And you can do that, for 10 years without any risk. So a lot of endowments, whether it's school endowments or individual endowments, like money market funds, because it's completely safe. And in the case of T-bills, you can get your upfront interest. Okay. Now, money market funds can also be used for investment accounts because, again, it's secure. But like we've said during this course, because the rates are currently really low, unless they rebound, you're not going to be getting above the inflation rate. So you're going to be essentially losing money if you park your funds in a money market fund. Commercial papers and bankers' acceptance are for experienced investors. Remember, you're investing in companies, not the federal government. So it's for savvy investors who can run the numbers, who understand the fundamentals behind those organizations and can predict their performance. And if you want to list in a comparative list of money market funds, I've provided a link just to get a sense of which money market funds are available, what the prices are, and all of that. Okay. Now, for the capital market, governments and corporates use the capital market to raise long-term funds. So while the money market usually has a defined tenor, 6 months, 3 months, 12 months, the capital market a lot of times can be open-ended. So sometimes you get tenors as long as 3 to 5 years, and in the case of stocks, it's open-ended. You can come and go as you please. You can buy and sell as you please. So examples of capital market instruments, we have fixed income instruments, which are typically issued by governments or large corporates. And it's simply debt where government really loans from individuals and companies. It's called fixed income because the returns are stated upfront. So unlike stocks where you're trading on the market and depending on what the market price is per time, with fixed income you typically know the return you're going to get upfront. Okay, let's go. So equities or equity mutual funds, these are high risk instruments comprising stocks and shares. So the popular stocks and shares that you trade on the market, they're also called equities. And for those who don't have the experience to pick the stocks themselves, you can join a mutual fund where an asset management company buys a selection of stocks and then presents that as a product that people can invest in. So for example, an asset management company could say, we're going to be investing in banking stocks alone, or we're going to be investing in the NSE 30, the top 30 stocks on the Nigerian Stock Exchange. And they've done the picking for you, they'll monitor it for you, they'll manage it for you. You just buy a slice of that product. And derivatives, as the name suggests, they're bespoke products that are customized from existing capital market products. So they're not pure play, straightforward products. These asset management organizations will package different pieces of different products to create a hybrid or a bespoke product. Now, if you want to compare capital market data, go to nsc.com.ng, go to broadstreetlagos.com. You can also download the Yocha app. So if you want to just monitor how the market is doing, do some trend analysis, these are the platforms that you can use. Now, what are the features of the capital market? The principal is typically guaranteed for fixed income, but not for equities. Remember what I said? For fixed income, you know the interest upfront, but equities, they're traded on the market, so it depends on the market price. So if you have a low risk profile, ideally equities should not be for you because the market moves very quickly. If you're not monitoring, sometimes you can lose the initial value. The initial value of your investment can go below what you expect. Okay. For equities, you receive a central securities clearing system number and a clearinghouse number. It's basically your unique identifier. So regardless of which broker you use or which brokerage house you use, maintain the same clearinghouse number. It's so that when you go on the CSCS website and you want to get a sense of all your holdings across different Nigerian brokerages, you can see it at a glance. So what usually happens is that people shop around because of fees or because of service. So you can buy stocks from any broker, but if you then want to be able to see your stocks in a central place, then maintain the same clearinghouse number when you go from broker to broker. You receive your share certificates. Nowadays, share certificates are digital. So you'll be emailed a document, something that just documents your trade. So that way, the day you decide to leave that broker, you can sell your shares anywhere else. So you might pay a fee or a penalty for leaving a broker, but your shares are fungible. You can move them around and you can sell anywhere you like. Okay. And for those who are risk averse, you can mitigate your risk by investing in a mutual fund, and I've explained how that works. You may also trade online. So gone are the days where you need to have a stockbroker, quote unquote. If you like, you can sign up to an online platform, buy yourself, sell yourself, trade yourself. So you don't need to send an instruction to a stockbroker. But for this is for people who have the skill to do so. And remember what we said when we were talking about in earlier models. We talked about time and attention. If you don't have the time and attention to manage your portfolio yourself, if the market moves suddenly, you may lose money. And then you can practice using gaming platforms. So there are stock trading gaming platforms where you don't need to spend any money. You're going to be spending virtual money, and that helps you learn how to buy, sell, and trade without having to risk any money. So this is an example of an online platform, Merry Trade, that helps you buy and sell stock. So you can see everything is online. You can view your portfolio, deposit funds, you can withdraw funds as well when you sell to your bank account. And this is an example of their their gaming platform rather. It's called Merry Games. So if you don't want to risk money, you just want to try your hands at buying and selling, what they've done is they've linked this directly to the Nigerian Stock Exchange, so you can see live prices. So even though it's a gaming environment, you can see the actual prices of the stocks per time. So it's your trading with real data. Okay, and as an assignment, if you're yet to trade equities, you can set up a free gaming account on Merry Game, or there's another one called Virtual Investment Simulator by Investment One, and just try trading for fun. Don't risk any money. See whether you get a hang of it and whether it's something that you're interested in. Thank you.